So, what we have been talking about is the optimal capital structure. And theoretically, the optimal capital structure is where your WACC is minimized, right? But it's not that easy to actually calculate. First of all, you should be using the market value of equity and debt when you're calculating the debt to equity ratio. Now, what does that mean? If you have your assets on your books as 100 million, right? And your liability is 50 million, and let's say your equity is also 50 million. Now, these are book values. Let's say this 50 million is bonds that were issued at $1,000 per bond when they were issued. But maybe the market value is different. Maybe it's trading at 1,100, or maybe it's trading at $900 per bond. So we need to check what the market value is. And again, with the stocks as well, maybe each stock was issued at $100 per stock. Maybe it's trading at 150 now, or maybe it's trading at 50 now. So when we're calculating the weight of debt and the weight of equity, we should take the market values because that is the current worth of that debt and that equity. But reality is that many times book values are used. Why? Well, first of all, because market values fluctuate a lot, right? And even though your market value will say that your equity is much higher than your debt because, let's say, stock price has gone up, and to balance that, the company should be issuing debt, but what they will do is they will issue even more equity instead of debt because they want to take advantage of that high share price, right? Similarly, another reason why the companies are more inclined towards focusing on market values not of their own stocks but of other stocks and bonds and other assets, because they are primarily concerned, the management of the company is primarily concerned with what they're doing with the money that they have, right? That is in the company, that is money invested by the company and not the money invested in the company. Because once that company issues, right, so this is, let's say, assets and liabilities and equity. Once the company issues those bonds, let's say each bond is issued for 1,000, that's what the company got. Now, whether it's in the market for 1,100 or 900, I mean, it's already past the point where the company got that money, right? So now whatever's happening in the market is a secondary market transaction. Or similarly, with equity, they got $100 per share. Now in the market, it might be 150 or 50. That's a secondary market transaction. However, if it is high, then the company might actually want to sell more shares at that high price. So instead of saying, oh, my market value of equity has gone up, let me issue more debt to bring my weighted average cost of capital to the optimal level, to bring my debt to equity ratio to the optimal level. But instead of doing that, the company might do the exact opposite, is that, oh wow, look, the share price is high, let me sell some more shares at this high price and get higher money into my equity, even though that might be different from the theoretical optimal capital ratio, capital structure, right? And your lenders, which is your banks and your rating agencies, will also focus on book value because that is something which is more stable. Market values are number one, fluctuating, and number two, subjective, right? They are subjective. Book value is based on hardcore accounting, based on what was the actual amount received by the company. As discussed, financing decisions are often opportunistic. Think of Amazon issuing that lowest, cheapest bond issue in the US history, right? So if it was a good opportunity, they availed it, even though they probably didn't need the debt. And the share price, of course, makes a big impact as well, whether the company would like to issue more equity or raise debt, depending on what is the current condition. Now, why is this important for us as analysts, right? Why do we need to understand all of this? First of all, when you're analyzing a capital investment, you need to use an appropriate discount rate to calculate your NPV. And the discount rate will be the weighted average cost of capital, and to calculate the weighted average cost of capital, you need to know the target capital structure. You cannot use the current capital structure, because if the company is planning a capital investment, then to do that capital investment, they might be planning to issue more debt or more equity, or whatever it is, it's going to change the capital structure. So we need to use the target one. Now, I remember when I used to be equity research analyst many years ago, I would actually call up the companies and try to ask them that, what is your plan? Are you planning on issuing more equity or more debt? And sometimes they don't tell you, right? Many times actually they don't tell you. So what you could do is estimate using one of these methods. Now, one of the methods is just take their current and at market value, not book value. So you will get the current from the book value, from the books. So take the book value and convert it to market value by taking the share price from the market. And if they have bonds, then take the bond price from the market, right? The number of shares will be written in the book value. The number of bonds will be written in the book value. But the price per share and the price per bond you can get from the market, the stock market, the bond market. And then you can say that is what the capital structure is. If they don't themselves tell you, if they themselves tell you this is our capital structure, then that is number one, right? That takes first priority. And from the exam perspective, what you have to do is that if the target capital structure is given, you have to take that. If the target capital structure is not given, then you will take the market one. And if the market one is not given, then you will take the book value. So if, let's say, the market is not there and the target is not there, what you can do is you can examine trends in the company's capital structure, that how it's changing. You can look at the book value and see, okay, maybe before they had 30% debt, now they have 40% debt, now they have 50% debt. So clearly you can see that there is a trend over there. Or what you could do is you could see comparable companies, right? You could see comparable companies that, let's say there's a new company called Lyft, right? And you want to think about what their capital structure could be. Maybe you can look at Uber, which is, of course, a similar company. So here is a question for you, and we've got 3 parts over here. This is coming from your CFA curriculum. So here we've got the market value of debt and equity of a company. Then we've got the data of competitors. And what we want you to do is calculate the target capital structure, number one, based on its current capital structure, which is for the market value of debt and equity of the company. Then based on the competitors. And then finally, if they tell you their target. Of course, this would be the best one, right? If they tell you. So anyways, let's try to do these. I've put them on separate slides with the data that you need. And so what I want you to do is please pause the video and try to calculate the capital structure for this company based on its current data. So hopefully you were able to do that. Debt, the weight of debt is 50 over 110, right? And weight of equity is 60 over 110. So that was fairly easy. The second one is a little bit more complicated because you've got 3 competitors. So you'll have to do it separately for each of these and then take the average. So try to do it and then I will show you the solution. Alright, so hopefully you were able to do it. So 25 for, let's say, debt first, weight of debt, it will be 25 over 75, 101 over 101 plus 190, and then 40 over 40 plus 60. So this way and divided by 3 because we're taking an average of these 3, and this is how you get the weight of debt. And similarly, you can calculate the weight of equity using the competitor's capital structure. And then finally, where they tell you that, hey, we are planning to take our debt to equity to 0.7. So what is my target capital structure? What is going to be the weight of my debt and what is going to be the weight of my equity? Now, this is a tricky one. You have to use your mind a little bit and see if you can try it. Please try to do it. See if you can do it, right? Pause the video and try to solve this one. Okay, so hopefully you were able to replace equity with 1 and then say, okay, if equity is 1, then debt is 0.7, which means debt plus equity is 1.7, right? So this is the tricky bit over here, that you have to assume equity as 1 when debt to equity is 0.7. And then you know that weight of debt will be the 0.7 over 1.7 and equity will be 1 over 1.7. And let me show you the solution as well. So here you can see that they are assuming equity as 1 and equity plus debt as 1.7. So 0.07 over 1.7 is your weight of debt, and weight of equity, well, they've just done 1 minus that, but you can also do 1 over 1.7. Okay, great. Now let's move on to the pecking order theory. And before we get into the pecking order theory, I think we should talk about agency cost. And before we talk about agency cost, we have to talk about information asymmetry. What is information asymmetry? What is symmetry? Symmetry means equal, asymmetry means unequal, and information asymmetry means unequal information. And think about it this way, right? I mean, let's say you have a cook that cooks for you. Who do you think knows more about what's going on in the kitchen? You or the cook? Definitely, the cook knows more than you. So similarly to that, a company, the managers of the company know more about what's going on than the actual owners of the company, especially when it comes to high-tech businesses. I mean, think about Apple. You think Tim Cook knows more about Apple or the shareholders of Apple? So because of this information asymmetry, shareholders are kind of looking for signs from the management to get an understanding of how good the business is going, right? And that's where this signal is coming out from the management. And the management always wants to give the positive signals. So what's basically happening over here is that if the shareholders see management taking on more debt, which is a fixed payment, obviously, shareholders feel that, oh, the business must be doing well, because if these guys can take on the risk of taking on contractual obligations of interest payments, then they must feel comfortable about the future prospects. Otherwise, why would they increase the financial risk? And managers know this, right? Managers know that the shareholders are monitoring this. So they don't want to take on more equity unless they really have to. They would try to take on more debt to finance their business before taking on equity, because they know shareholders will take the taking of debt as a positive sign, but taking of equity as a negative sign, because taking on equity means that either you're not getting debt or you're not comfortable taking on more debt because you have to pay them the fixed payments, and equity holders, you don't have to pay fixed payments and you need equity to cushion your losses. So that's why we come to the pecking order theory, which gives the third priority to equity financing, second priority to debt financing, and first priority to internal financing, which means using your own business's profits and cash flows to fund your business expansion. If you can't do that, your existing cash flow is not enough, then you should go for a bank loan. And if you can't do that, then only should you go for trying to raise more equity, because that will give a bad signal, right? That you're not being able to get more debt, or you're not comfortable taking on more debt because you're not so sure about your future cash flows. So this is where the pecking order theory comes in. And why? Because agency costs. So how do agency costs fit into all of this? And remember, I told you that increasing your debt actually increases your financial risk, and that is true. But there is little bit of a benefit that comes in terms of the agency costs, because think of CEOs of big corporations taking private jets here and there and using money in inefficient ways, wasting cash. But if they increase the debt, that means they have to pay the interest on time, and they will have less money to play with. And that's something that reduces agency costs, right? Which brings me to the free cash flow hypothesis, which says that if you want to discipline your managers by forcing them to manage the company efficiently so that it can make interest on time, so therefore increasing debt, high levels of debt actually can help you reduce agency costs, because managers will have fewer opportunities to misuse cash. So that is your agency cost and the pecking order theory. That is the end of this learning module as well. What did we talk about? We learned how to calculate the weighted average cost of capital, weight of equity into cost of equity, weight of preferred equity into cost of preferred equity, weight of debt into cost of debt, multiplied with 1 minus the tax rate, because interest is a tax deductible expense. And this is the discount rate we use for doing our NPV, IRR, all of the capital investments discussion that we had, right? And this is the discount rate which should be less than your IRR for your NPV to be positive. What else did we talk about? What is the optimal level of that debt to equity ratio? How do we get to it? What determines this optimal mix, right? What determines the cost of equity, the cost of debt? Why would somebody want a higher return from us, whether it's debt or equity? Depends on our riskiness, right? So they look at top-down factors such as what's happening in the overall economy, and they look at our company-specific factors such as our sales risk or our profit risk or our financial risk, which is already existing debt levels, or our operating risk. Also, it depends on where we are in our life cycle. What is our business model? Is it capital intensive? Is it a startup? Is it mature? Right? So, are we capital light, capital intensive, and what part of the life cycle are we at? So, all of these factors actually impact the capital structure and the weighted average cost of capital. Then we got into the Modigliani and Miller propositions, where we said without taxes and with taxes. Without taxes, we said WACC stays the same because cost of equity goes up, and hence your value is the same for leveraged or unleveraged firms. But with taxes, we said RE does go up, but not so much because it's muted with the tax benefit, and therefore the value of the leveraged firm is greater than the value of the unleveraged firm by the amount of the tax shield, which is tax percentage into the debt amount. And then we brought in our static trade-off theory, which says, hey, okay, tax benefit is there, but there is also the present value of the cost of financial distress, which means at some point your WACC will start going up again, and that is the point where your firm value also maximizes. So this is the value of the leveraged firm, and this is your WACC, and this is your debt to equity ratio, and at some point the value of the firm gets maximum, the weighted average cost of capital minimizes, and that is your theoretical optimal debt to equity ratio.